Hi, dreamers. I've gotten a lot of questions lately on XDTE and QDTE, which are two relatively new covered call ETFs. And so today I wanted to cover some of these 0 days to expiration covered call ETFs and how they're doing against the other covered call ETFs. Because these are the latest, most exotic income derivative funds to add to the zoo. So quickly before we dive in, what exactly is 0 DTE? Well, it stands for 0 days to expiration, and a 0 DTE option is an options contract set to expire at the end of the current trading day. And so the new funds that I'll be taking a look at today are all 0 DTE covered call ETFs. But just as a point of clarification, any options contract that you have, even if it was issued a year or a month ago, becomes 0 DTE on its expiration date. Alright, so the first one is XDTE, which is essentially the S&P 500 product from Roundhill Investments. And you can see here that XDTE seeks to provide overnight exposure to the S&P 500 and generate income each morning by selling out of the money 0 DTE calls on the index. You can see the distribution rate at about 34%. And if you scroll down here, you can see an expense ratio of about 0.95 and the assets under management. You can see the holdings are essentially just calls on the SPX, which represent the S&P 500. And if you go to their sister fund, QDTE, you can see that essentially it's the exact same thing, seeking to provide overnight exposure to the NASDAQ and generate income each morning by selling out of the money 0 DTE calls on the index. Their distribution rate is 67.4 and also has an expense ratio of 0.95. And again, here you can see the holdings are calls on the NDX, which represents the NASDAQ. Now, really fast, what exactly is out of the money calls? So when we say out of the money, a call option is considered out of the money when the underlying asset's current market price is lower than the option's strike price. And so imagine doing that every single day. Now, one thing that's interesting and unique about the XDTE and QDTE funds is that not only is there no equities in holding, and it's only an option strategy, purely financial gymnastics, but these funds have a weekly distribution, which is definitely new. And essentially what they're doing is flex options, which is kind of hard to do for the average investor. Now, since I've been asked about these 0 DTE covered call ETFs, I might as well also show you two more. Specifically, ISPY, which is a product from ProShares, which also seeks to track the performance of the S&P 500 daily covered call index, and does that through the sale of daily call options using swap agreements and does not trade options. You can see in their snapshot their expense ratio is a little bit lower at 0.55. And another difference is that these guys pay monthly, not weekly. And you can see a difference here is that they are leveraging Goldman Sachs in their swaps. And again, their approach is to have a short position in a one-day out-of-the-money S&P 500 index call option. The option is sold daily, and the strike of the option is chosen as a function of the S&P 500 index and VIX index levels. Now, ProShares also has a sister product, IQQQ, and it's basically got the same characteristics with that 55% expense ratio and a distribution of monthly. So let's take a look at the distribution histories of these funds that have not been around for very long, and then take a look at their total return performance in Seeking Alpha. So if we go to XDTE, we can see under dividends and dividend history that the dividends so far have been very inconsistent, as low as 2 cents and as high as the latest one, which was 41 cents. And so you can see that this is going to be a very volatile weekly distribution, because as they make their daily bets, they're either going to do well or not do so well, because they're focusing in on at the money to maybe 0.5% out of the money. Every day you may lose or gain on these super short calls. And one of the things to be aware of is that NAV erosion could occur on these if the up and down happens very quickly. And I would hope these wouldn't go to zero. And if we take a look at ISPY and their dividend history, we also see a little bit of an irregular pattern from as high as 48 cents to as low as 27. So that's just something to be aware of over time. So what I wanted to do for you was plot these in their sort of apples to apples comparisons. So what I've got in this Seeking Alpha graph, which as you know, I'm an affiliate, and if you're interested in them, feel free to look at the link below. But looking at XDTE, which remember is the S&P 500 product, you can see that since launch of 3/8/2024, which is a really short period of time, so keep that in mind, their total return has been 6.43% as compared to ISPY, which is 5.27%. Then we have just the regular index of SPY returning 4.82%. And then I always throw in my Devo, my beloved Devo, because it's not really an apples to apples comparison because it's such a custom covered call approach. But it's so consistent and so conservative. I always like to throw it in just to see how it compares. Then we've got the Goldman Sachs product of GPIX returning 3.67%, SPYI, which is another monthly covered call approach, returning 2.87%, and then at the very end, we've got JEPI returning 1.71 total return, which again really isn't the total S&P 500, but is one of the most popular funds, so I do like to throw it into the comparison. So overall, actually these daily covered call approaches seem to be doing pretty well in the short term. Let's take a look at the NASDAQ equivalent. Now this time frame's a little bit shorter because one of these products, IQQQ, launched right around March 20th. So we know that the NASDAQ has been pretty bonkers in the last 5 months and has experienced a pretty significant drop. But even with that, QDTE returned a 2.7% total return. Of course, I throw Devo in here just to be, a contrarian, even though it doesn't really belong. So let's get rid of that. We've got QQQ, which is basically just the regular index, returning 1.66% in this time frame. IQQQ at 0.94, QQQI at 0.66, GPIQ at 0.62, and JEPQ, which did not do very well, with a 1% loss during this time frame. So what's the net of all of this comparison? Well, for me, I just want to point out that looking at only a 5 or 6 month time frame is really too short because the market dynamics change wildly and thus the performance of any fund. And these funds are just so new. So I would encourage you, if you want to try them, to put a little bit of money in and then monitor as we go and make note of how they perform across different market timeframes. The other thing I wanted to point out is that if you're watching and you're relatively young, and when I mean young, I mean in your 20s, 30s, maybe even early 40s, you might want to focus in on just the index themselves, because over the long term, QQQ and SPY are going to outperform any of these other covered call derivative funds. That's my expectation. The third thing I would say is we know that there's a little bit of a concentration in the Mag 7, and you can see a little bit of the trend here as we've lost some steam in the last few weeks. So one thing you might want to do in the short term is focus in on the SPY products, and you can maybe wait out a little bit of a downturn in the NASDAQ. And the fourth thing I would say, and really how I'm thinking about all of this, is that with everything else in your portfolio, you might want to consider just doing a mix. So we've covered 0 DTE options from Roundhill, 0 DTE options from ProShares. We've got the custom Amplify mix from Devo, which does cover to call options on individual stocks. I've got dedicated videos on GPIX, SPYI, and JEPI and JEPQ, which do monthly call options. And all of these have a little bit of a different approach to how they're doing it. So the way I'm thinking about this long term is just creating a mix, not only amongst the derivative options, but amongst all of my portfolio, all of the other stocks, ETFs, and even bond funds, in order to have a widely diversified approach so that you can withstand any market condition. And the last thing I'll leave you with is, just because I cover something on my channel doesn't necessarily mean I'm recommending it or including it in a meaningful way in my own portfolio. So as I expose some of these to you, it's up to you to determine, do you want to test some of these, include them to change the mix of your portfolio, and spread some risk? shift more to income because maybe you're closer to retirement, or maybe just stick to the broad index if your time frame is 20 to 30 or even 40 years out. So I hope that was helpful for you, and let me know what you think in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.